Welcome to Market Monday from the investment team in the trust department at the First National Bank. So we have some pretty interesting stuff happening over the next couple of weeks, including a presidential election and, the Federal Reserve's rate decision, along with some information in the economy. And we're going to actually do things a bit unconventionally from our point of view and start with the market, because it's around this time in the election cycle that we get a lot of questions from concerned clients and prospective clients about what's going to happen to their portfolio or the market in general, whichever candidate gets into the office in the election, and how the configuration of Congress looks between, which side of the aisle it tends to lean. So we've gone back over history and examined various market cycles, and obviously they're related to various election cycles and various political cycles. And what you find is, back in the 80s, this is the S&P 500 from, 40 years ago until 20 years ago. And over this time period, we had a lot of different types of administrations. And you'll notice there's, market crises here and there, ups and downs, and an overall uptrend, and the market ended that period up. Did the political cycle have some minor influences? Policy decisions potentially have some minor influences on the economy, or even major ones? Sure. But the market is the market, and the market's going to go where it wants to go, irrespective of what's happening in Washington, D.C., because, over the grand scheme of things, or in the grand scheme of things, and over long periods of time, what do we get out of Washington? Well, let's be real. Not much of anything comes out of Washington. And so we're looking back at that period up to 20 years ago and the prior 20 years. And if we, do this again over the past 20 years, we've had, again, a variety of different configurations of government. In other words, how Congress was configured and who was in the White House, etc. And it's the same overall thing. The market's doing what it's doing, and the longer overturned trend is, again, up over the same 20-year period that we're looking at most recently. So what's the takeaway here? Well, we're going to go ahead and say that there's not much influence from Washington, D.C., and whoever's in the White House or whoever's occupying the halls of Congress with more power, there's really not likely to be a heck of a lot of difference. The market's going to find a way to do what it wants to do, policy decisions aside. So with that said, we hope that, that kind of gives a better picture of what's going on and decouples the idea of, there's some sort of impending catastrophe if our favorite candidate doesn't get elected. Probably not, is what history is telling us. So now moving into the stuff on the economy, later today we're going to get information about demand, specifically factory and durable goods orders, which are really consequential. They're expected to show either a flat or an accelerating slowdown in the pace of orders. So that actually augurs that, potentially the economy is going to slow. Potentially the economy might slow a little bit too much and tilt us into recession. We want to pay attention to those numbers. We're going to get information about the trade balance and what the outlook is in services. We get information about the labor market, productivity, and unemployment claims, and that's going to be key. The Federal Reserve is looking at employment situation, and they're looking at inflation, and they're trying to balance out all of the risks without pushing the economy into recession, but without letting inflation get out of hand and reigniting and moving the economy forward too quickly again. So they have a very delicate balancing act to do, and they're watching these numbers very carefully. And speaking of the Fed, later this week we get their decision, and the market's expecting a 25 basis point rate cut. And, based on the strength of the economic reports that have been coming in lately, it seems reasonable to expect that. So, they probably have the room to do it. Inflation's gotten down closer to their 2% target. And, in fact, they may have achieved that soft landing. You could make the argument that potentially they don't need to make another rate cut. But at this point, it doesn't look like they're pouring gasoline on a fire with respect to inflation. So, we will next week get some inflation information. Consumer inflation, which is expected to be basically flat, and producer inflation, which is expected to be a little bit of a growth spurt on a month-over-month basis. That's important to pay attention to. We don't want to see prices going up too quickly and signs that inflation is reigniting again. We don't want to see that, particularly in light of a potential Fed cut later this week. We would really not want to see big, inflation numbers come next week after a rate cut. That would make the Fed look kind of, potentially jumping the gun with that rate cut. So they have to be careful, and we would potentially expect volatility if these numbers do come in hot. It might signal an end to the cutting cycle for now. We'll get information about sales, expected to still show growth, but slow a little bit. That's actually a Goldilocks expectation. Potentially, sales being the driver or the main driver of GDP growth. We're watching that pretty carefully, but that's still a positive number, suggesting that, maybe they did succeed this time in that soft landing, and they engineered, a slowdown enough of inflation and getting that under control without damaging the economy so much that we go into a recession. And if these numbers are going to hold and they come out as expected, that would be evidence in favor of that hypothesis that yes, they have achieved their soft landing. Moving into rates, we're looking at the 10-year curve. That is pretty nice. That the short end is likely to come down a bit, and we're seeing increased rates. We'll probably see that continue to increase on the longer end of the curve as overall higher inflation rates and a normalcy returns to interest rate expectations as we see the economy starting to heal and stabilize. So, these rates are pretty good as far as treasuries are concerned in the recent past. Certainly when we look at the corporate yield curve and we're seeing 4.5% up to about 5.5%, maybe a little bit more on this yield curve, things are actually returning to a more traditionally normal shape for yield curves. And what does this suggest? Well, an interest rate is basically the price of money. So, this is what corporations of good credit quality are being charged to borrow money over longer time frames. For instance, 10-year paper is an average of about 5.16. 25-year paper is about 5.5% for any given issuer, and that tells us that's the cost of money for high-quality companies to borrow money. That's a lot closer to long-term, traditional averages in this respect than what it was for, up until a couple years ago when inflation really ignited, where we were in an almost zero interest rate environment. That's an unnatural anomaly that's unlikely to return. There's a lot of talk by various pundits that we're headed back toward this, very low interest rate environment. And we don't see that happening for a variety of reasons. The chief one of them is that what was driving rates so low was globalization. And in the context of globalization in the 90s, and early aughts and the mid-teens, you had cooperation, and cooperation allows for the division of labor to go into full effect, and everybody's able to do things a little bit less expensively because the people that are the best at doing things are the ones doing it and focused there. Now, instead of a cooperative environment, we're seeing competition among the great powers. Everybody's resourcing their critical industries and having to do it themselves. So as a result, we're looking at a potential inflationary environment that's going to last on the secular level. In other words, a long-term higher level of inflation, a longer-term higher level of interest rates would be the following consequence on that. So that's what we see when we see a rising yield curve, and it is up over the longer-term parts of the curve quite substantially over the past month. The same thing in the treasuries, and the reason for that is longer-term inflationary expectations are being ratcheted up a little bit higher, and even though shorter-term expectations, rates are likelier to come down. These curves are telling a story that says, hey, the market doesn't believe that it's going to remain a low-rate environment forever, and even if the Fed comes down that 25 basis points today, or not today, later this week, we're going to see still above 4% for the government. So that's still relatively high compared to what the recent standards were before this recent bout of inflation. So moving back toward markets, what's happening in the S&P 500 now is what's happening, been happening for the past year. It's just marching up and up and up. We don't expect to see much in the next couple of days, but later in the week, post-election, we could see a spout of volatility. So, just be prepared for that. The market participants have certain expectations, and they will be trading based on, how the candidates are doing and what's said, what's done, events around the election, and et cetera. So short term, we could see something happen. Remember, though, when we zoom out to the longer term, we're expecting things to not really be all that much different. The trajectory of the market is going to likely remain pretty constant. And, until some big shock comes, or at least some shock that's of a sufficient magnitude to slow things down, we're expecting the market to continue marching higher, until we're seeing evidence otherwise. So, if you have questions about your portfolio, if you have questions about the economy, if you have questions about what strategies you should be using in order to achieve your financial goals, we would love to talk to you. Hope you found this video useful. Thanks. Have a great day.